Hey guys, I wanted to bring to you kind of an interesting question that a friend of mine had for his macro. It was a practice test, and he had a graph that looked like this. It was on aggregate demand. So supply, AD1, and you had a fall in aggregate demand. So what would cause this? And the question is, what would not cause this? And one was a decrease in what I think it was inflation or the price level, or so a decrease of inflation. Now, my friend had answered, or it was, what was the least likely cause? I think, yeah. And so it was a decrease of inflation. And I said, well, actually, that I think is correct. That a decrease of inflation would be the least likely cause of a decrease in demand. Or, sorry, of most likely. What was the thing? Increase of inflation? Well, anyways, what I wanted to get at was that the instructor said that was not the answer. Most likely cause, least likely cause of, now I can't remember the exact problem. But my point was that actually a decrease of inflation would cause people to reduce their demand for products and services. And the reason for that is Milton Friedman said the way to avoid or to beat inflation is through, how do you beat inflation? You can try to find ways where investments will beat inflation, but he said the best way to do it is through high living. That is, in times of great inflation, and actually if you read the Modern Monetary Theory, where even Paul Krugman, obviously you'll know I'm not a fan, but he did have a good article on that MMT would cause more inflation because you would have the government printing money that would cause, we would say that is inflation. But from a mainstream approach, we would say that would cause inflation. So we'll say price inflation, okay? So that would cause price inflation. Prices would go up and people would see that and they would take the money they have and they would go out and spend it very quickly, and that would cause prices to go up even more. And so basically the idea that an increase of the price level, we say price inflation, would cause actually demand to go that way. So therefore a decrease in the inflation level would cause this to happen. Right? And so that's why I'm struggling to remember what exactly but I think they said, I think he said this was the least likely thing to occur. And I said, actually, this I think is the most likely thing to cause the graph to look like this. And again, it's because if you think about it, if your money is losing value, let's say you have like a 20% inflation rate. So that means if you hold on to $100 until the end of the year, it's really only worth $80. That is, it only buys $80 worth of goods. But if you spend it today, it will still buy $100 worth of goods. And so you see in these hyperinflationary scenarios, famously in the Weimar Republic, when they were in massive inflation, that is, prices might double, over the course of a lunch period. So literally, they would come. Wives would bring wheelbarrows to the factory, and the factory owner, the employer, would pay his employees, and they would give the money to their wives. The wives would immediately go out and buy stuff. So you see, nobody's going to save money when it falls in half in the period of 24 hours. $1 is worth 50 cents tomorrow, 25 the next day, 12 and a half, 6.25. Eventually, it's not really worth anything, right, by the end of the week. So people would just spend money, and that would that increase in demand actually causes prices to go up even more. So you see a And if you think back to the MV equals PY, so if you have lots of printing of money, that alone is going to cause prices to go up. And then if you increase the velocity, that is, people spend money a lot, they spend it very quickly, that's going to cause prices to go up even more, right? So if this is an equation, famous Milton Friedman, the velocity of money equation, where this is real output is not going to change significantly in any short period of time. But if government is printing a lot of money, that's going to just not backed by anything. It's just representing nothing, and it's gone and it's spent. And people see that. That causes prices to go up. People say, "Oh, there's more money in the economy." Then, money loses its value, and you're going to have to give me more dollars in order for me to give you my car or whatever. And then, if that happens very quickly, people see that their money loses value, and they want to get rid of it. Hot potato. And so they increase the velocity of their spending. That is, instead of holding on to $1 for a week, they spend it immediately, and they would spend it 7 times over the course of that week, or if it gets really bad, maybe 14 times a week instead of once a week. So that velocity would increase exponentially, and these two things going up would cause prices to skyrocket. Because again, if you think about how a factory puts goods out, it's not like they increase the money supply by $1 billion. A factory can just instantaneous pump out an extra $1 billion worth of goods because, oh, there's money there. Let's create more goods. We can get in deep into in fact, I will in another video, supply side economics, and why output is pretty stable. Real output is pretty stable. Money supply, because we have a fiat monetary system, is very unstable, or it can be. And so you would see that. And therefore, again, a decrease in the price level would likely cause people to see, oh, my money is going to hold value a little bit longer. So instead of spending it immediately, they would be more likely to hold on to it for maybe a little bit longer. And as the price level comes down, they would continue to hold on to their currency over time, right? So the supply is fixed. So a decrease in the inflation level would most likely cause people to reduce their spending. Now, this is kind of the funny thing with economics is you have was it Nixon or Reagan wanted the one-armed economist? Because on the one hand, but on the other hand, so just give me an answer, right? well, that's, I think, what I would say. But the answer that he had, this other professor had, was that a decrease in the price level in the US would actually cause a decrease of inflation would cause prices in the US to decrease, and that would cause more foreigners to come and buy domestic goods, and that would cause an increase in demand. Now, I question that. It's just inflation, and usually it's a ceteris paribus, so the price level in the US falls relative to some foreign country. You might be able to increase exports because domestic goods become relatively inexpensive compared to what they were. But you know what? That takes a little while. So does the thing that I was talking about. So it's which one has the greater effect. So I think to say that this is the least likely, I think would be wrong, because I think that would be the most likely, a decrease in the inflation level. It really depends on what the inflation level is. If it's 0.5% and it goes down to 0.25%, that's not anything significant. But if you're talking about a high level of inflation, of course if you're talking about high level 20 and it goes down to 10 or something like that, people see that their money's starting to hold value a little longer, they'd be less likely to go out and blow it on whatever the first thing they find, right? So that's a little something on that I just came to mind when I had some free time here. I mentioned the idea of supply side economics, the reason that increases in the money supply will not cause increases in the output. So an example I had is, suppose you have a bagel factory, a bagel shop or a donut shop or whatever, and you're next to a hotel, you got hotels in the area, and you suddenly see a huge demand for for your bagels this weekend, right? You're like, oh wow, there must be an increase in demand. I can increase output in my present factory. So I'm pretty limited in how much I can increase. I could probably put out an extra several dozen. So I might temporarily increase my actual output given the increase in demand. But if I foolishly think that this is real demand, that like this is an actual long-term sustained increase in the demand by consumers, demand backed by actual goods. Because remember, Say's law says goods, this is really important, goods buy goods. So if there's an actual increase in the amount of goods in the economy and they come to my bagel factory and they start buying more bagels, so what you do is you make something, you trade it for money with somebody who has money, and you take that money and you buy more goods. So shorthand, you trade your goods for somebody else's goods, right? But when you get fiat money in here, if that bagel shop was to foolishly think that this sudden increase over the weekend was a real sustained economic output, increase in output, and a real sustainable demand for their bagels, they might open up a shop next door and expand their factory. But if you think of it as just an increase in the money supply, no real increase in output, that bagel shop decides, oh, we've got this great increase in the demand for our bagels, we think it's gonna be long, so we're gonna expand. And then it turns out that it was just a convention going on next door, and by Monday, all of that demand has fallen off. So in terms of the money supply, government prints out $1 billion, money is spent over the weekend. By the end of the weekend, that money is spent, it's gone. Now the bagel shop notices on Monday, we signed a lease for the building next door, we increased our productive capacity, we bought capital equipment with the assumption that there would be a real money coming in, but it turns out it was actually fake money, or in terms of the bagel, it was just a convention going on next door. It was a very short-term stimulus, and they've invested a lot of money in new capital with the assumption there's going to be an increase in demand that does not sustain itself. And so what happens is that, in this case, the bagel shop would probably collapse, right? They racked up a lot of debt, and this goes to the the way that inflation fools entrepreneurs. But coming back to this, it's, if they were to try to really increase their output, who's going to buy that stuff? In terms of bagels, who's going to buy bagels? Are people going to go out and suddenly buy more bagels because they produce more donuts and trade? Unlikely, right? So in real terms, it's very difficult to actually increase real output, especially in a short period of time. It takes a much longer period of time to actually increase output, and you're certainly not going to do it by simply printing worthless money, right? So if some companies actually do increase output on its own, then you might need an increase. You don't actually need an increase in the money supply, but you could, to keep prices stable, you would need to have money supply follow the actual increase in output. Friedman actually had talked a lot about this. He was against the gold standard, but he did believe in some kind of standard where money supply growth would be linked to population growth or something or they would just fix it at 3% or something in order to stabilize prices and the currency. But you would need that increase in output first, because you need the increase in goods before you can buy more goods. You can't just print money and assume that that money is going to be followed by goods, because again, it's inflationary. It just means that there's more money, and that doesn't mean that there's more goods. So if goods are traded for currency and then traded for goods, and you increase the currency, you have the same amount of goods buying the same amount of goods, but at the currency that is the medium of exchange, it loses value. So these goods are going to be traded for a greater number of dollars that will be traded for the same number of goods. So in terms of the supply side economics, I could also go to think about you're born in this world with nothing, right? You don't even have clothes, you've got nothing. you're just naked, you have nothing to exchange. Over the time, you build up skills to where you can start to produce goods for somebody. He gives you dollars and you go out and you buy goods, right? Now, if you were born and you were able to just produce dollars, I would say, if you probably never heard of it, Gilligan's Island. So they go on an island. The running joke was that the Howells are billionaires, and they brought a suitcase, and they brought a trunk full of money, probably millions of dollars in this trunk. And so they had all this money, right? They had all this money, but what can they do with the money? Nothing. The running joke is they're always trying to buy favors and things from their fellow castaways, but their castaways kind of laugh. It's like, look, we're on a desert island. Yeah, you got a lot of money, but it doesn't mean anything. It's the best thing we can do with those dollars is start a fire, right? So money doesn't have any value unless it's backed by goods. So anyways, I wanted to just kind of bring up that thing on inflation. So again, let me just go back to where I started. If you decrease the inflation level, that means that money is holding its value relatively better, and people are less likely to be spending it immediately. They're more likely to reduce the economy-wide. People are more likely to save, and that would cause a decrease in demand for goods and services. So anyways, that's what I wanted to say. So hopefully you enjoyed that lecture, and hopefully it was understandable and reasonably clear.